Welcome, everyone, to a quick discussion on the Column E funds and strategies through the month of June. I am Brendan McCarty, founder and CIO of Column E. Before we begin, just a quick reminder that you can get more information on Column E at columne.com, and you can find yours truly as well as Column E on Twitter, LinkedIn, and other social media platforms. Finally, on Monday mornings, I join yourfinance.tv for a discussion and an outlook on the markets for a given week. We cover earnings and other quick topics. I believe we covered CPI last week. So let's dive into this month's report, discussing our funds and our strategies. For this month, we began with a discussion of mean reversion versus momentum investing. How this relates to CE is we aim to balance these strategies, utilizing risk management and trading opportunities arising from extremes in market behavior. The 3LW is our new product, is riding the wave of long and short momentum within these markets, believe it or not, even as the broad markets rally, while the pools, which are more contrarian based, are fighting this market unsuccessfully, even though in May we had our best returns in a while, only to give back some in June. We believe maintaining equilibrium is an optimal strategy, and making contrarian trades against prevailing trends will lead to success. It's just not happening in June. June's momentum hurt returns of the contrarian strategies and simultaneously saw a solid upside to those who use momentum, like our 3Ls and notably our 3LW. We continue to believe that momentum is hitting an apex, however, as May demonstrated, and a two-way ebb and flow trade is in the cards. In regards to each of these strategies, let's go into discussion on the pools, 3LW, and everything else we cover more or less. So for the pools, Harbinger and Torrent were lower this month as trading was erratic, and there were a few opportunities to take advantage of, honestly. In May, we had a dozen trades. In June, trade plummeted to one-third of that. Harbinger EN was neutral. So Harbinger EN is the lower volatility option compared to Harbinger and Torrent. Torrent's trend following, Harbinger is more contrarian based. Harbinger EN is a mini-me, we like to call, of Harbinger LR, and it was neutral for the month as cash interest earned offset any small losses from trading. The scarcity of trading opportunities affected all the pools, leading to missed opportunity to the rising market and impacting returns. And risk management, while beneficial, is keeping the trend component out of the market at the moment due to the very elevated levels of momentum at the macro S&P 500 level, which the 3Ls and the 3LW do not take into account necessarily. We remain hopeful that the pools will begin to see more opportunities as the second half begins. For the 3Ls, which we talk about every Monday on yourfinance.tv, as well as all over our website, and they had positive returns for the month of June, driven by various movements in the portfolio. However, when assessing the performance over the entire 6-month period to start the year, the 3L50 and 3L100 continue to lag behind the benchmark SPX and NASDAQ 100. Limited exposure to top performing stocks and poor selection of the market direction have impacted their performance. Earnings performance in June saw significant gains on the short side, surprisingly, as we were notably AAP and GIS, while the long side made minimal contributions. Unlike the 3L strategy, the strategies do not overweight or underweight, so it's a flat, even portfolio of returns. The 3LW, on the other hand, does do an overweight, underweight relative to the growth model that we employ in the algorithm for the commodity pools. It delivered a strong month of returns as we were overweighting some opportunities on the short side that exploded in our favor. The return for the month was 9%. It was slightly lower than the previous month in May because that featured a better defensive DT, which is part of the algorithm for the pools. This month, it actually had a negative contribution. So this was all equity-based returns, as futures trading was just very difficult at the S&P level. The performance of the DT, we believe, will turn back up for next month. Though trading, if you're a futures trader in the S&P, you attribute. If you haven't been following momentum, it's a little harder. Hedges we implemented late in June also led to upside gains because the portfolio was heavily short. We went long SPY and QQQ, led to opposite returns. In terms of themes going forward, First, the current market environment shares similarities with movements of the equity markets in 2003 and 2009. Now, I lived through those periods of time, so I know those periods a little better. For those who are sort of new to the market, if the GFC is your boundary of sorts, 2003 and 2009 were both market bottoms of sorts that we took off from, each rebound of market lows. In 2023, we had a similar takeoff in March, as you all know. The bailout of the regional banks have driven the S&P and NASDAQ to 52-week highs, but the risks do persist. The current rally appears to be driven more by risk appetite compared to versus earnings and other factors that actually drive equity markets that most people that hang their hats on. Liquidity is also a crucial factor, and it was the key driver, in our opinion, that drove the NASDAQ up 22% through May, off those lows, and up about 39% almost at this point. Liquidity, is trending lower of late. So last night's report showed liquidity moving a little bit lower. It hasn't made a lower low, though, however, and still remains higher than March. Thus, we have higher liquidity, higher returns, higher capital for the consumer. So while the S&P may be showing some risks in terms of liquidity, in terms of the lack of earnings growth, risk extension is still very much in store, and the little liquidity that is out there is being amplified by the higher risk taking. As for the rest of the summer, expect trading to slow some as vacation trade takes hold. It may have already taken hold the last few days as NASDAQ volume is down appreciably. Earnings season is upon us, so that will keep our 3Ls busy and our 3LW busy. But once the news is released, the stocks tend to go to sleep at this time of year. The Fed meets at the end of the month, however, and that will be the big news, so to speak. Our worry, and I think the Fed agrees, is one example we use the Dallas Fed trim mean. It's still elevated at 4%. Any inflation at 4% is too much inflation. We know the CPI fell the other day. It still remains elevated. I know people expect it to go lower. However, that's really not in the cards because we believe wealth accumulation is on the rise, which means more money for the consumer to spend, i.e. cruises and planes right now. And if that is the case, you'll start to see inflation turn, which the market is not pricing in. As for the strategies, we believe the ebb and flow is trying to make its way back into the market. We believe a turn in inflation might drive that, as it will change up the status quo. The slowdown in the 3Ls relative to major indexes is one indication for that for us. Another was the performance of the pools in May. So if the pools continue to perform like they did in May, ignoring June, that means ebb and flow trade is going two ways, and that means momentum is less predictable, which pulls traders out of the market. If it pulls traders out of the market, creates a liquidity vacuum at times and creates bigger returns when we trade against the herd. So with that said, thank you again for joining us for this month's CE Fund Strategies and Fund Returns. Apologize for that. You can catch the latest from us at Column's blog, Between the Columns. We also post to Twitter, YouTube, Facebook, and LinkedIn. Thank you again for joining us, and have a great rest of your day and a wonderful weekend.